Hey traders, Money Badger here, and I'd like to welcome you back to Badger Trading University. If you haven't already joined the BTU Discord, click the link in the video description below. In our previous video, we gained an understanding of the stochastic oscillator, which helps traders identify changes in momentum. In this video, we will take a look at a technical indicator used to measure volatility called the average true range, or ATR. As a lagging indicator, the average true range, or ATR, illustrates how volatile an asset is on average over a specific period. We will be focusing on the 14-period ATR, but the 20 and 22 periods are also commonly used. The ATR takes into account huge price movements, such as gap ups or gap downs, and allows traders to get a better idea of an asset's volatility rather than simply comparing daily opening and closing prices. The ATR is expressed as a dollar amount, and the higher the ATR, the more volatile an asset is, and the lower the ATR, the less volatile. As seen in the chart shown here, the ATR's lowest value indicates that the asset had a price range of about 70 cents, and the highest ATR value indicates the asset had a price range of about $1.25, which is a much larger margin for price movement. The ATR is represented as the greatest value of the following: either the difference between the current high and the current low, the current high and the previous close, or the previous close and the current low. It is important to note that ATR does not show traders whether an asset's price is increasing or decreasing, but rather that the price is moving strongly in one direction or the other. The most common use of the ATR indicator is to identify appropriate stop losses. Generally speaking, using a larger stop loss during higher volatility and a smaller one during lower volatility may help traders further protect their capital and avoid getting prematurely stopped out of a position. Traders who set a stop loss too small often get triggered out of a winning trade. A good rule of thumb is to set a stop loss at a multiple of the ATR, such as 2x, either above or below the entry point, or 1x ATR above or below support or resistance, depending on if you're taking a long or short position. In the chart shown here, a trader decides to enter a long position at $22. Then a stop loss is set below the entry point at 2 times the current ATR value of 73 cents, which is $1.46. $22 minus $1.46 is $20.54, which is where the stop loss is placed. Notice how the price dropped at one point. However, since we kept the asset's volatility in mind when selecting our stop loss, we were able to remain in the trade and continue earning additional profits. In this chart, a trader decides to enter a long position right around a key area of support. Instead of setting the stop loss at 2x ATR, it might be more appropriate to set it at 1x ATR. Ultimately, the multiple that a trader decides to use is a personal decision. Most traders use 1x, 1.5x, and 2x when setting their stop losses. And as always, I would like to remind you that it is important to know that technical indicators are not meant to be used by themselves when making trading decisions. Trading with confluence and stacking elevating factors can strengthen your risk management and prevent entering or exiting a bad trade based on false signals. Always look for multiple signals to support each of your decisions. Thank you so much for watching. If you enjoyed the video and learned something new, please like, subscribe, and join our Discord by clicking the link in the video description below.